Hi, everyone. This is Jason Biarco of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. Now that the gold price has rallied a lot in just the last couple months, I think it's up almost 25% in US dollar terms in just the last 2.5 months. I'm excited to have back on a newsletter writer for many years, book author, and also a money manager. He does both, Chairman and Chief Executive Officer of Adrian Day Asset Management. Adrian Day, thank you for joining me again.
Well, thank you, Jason, for having me.
So, Adrian, we're recording this interview on Monday, April 8th, 2024. The gold price, like I said, the rally has just been absolutely incredible the last couple of months. I was speaking to generalist Keynesian hedge fund managers, I think in November, December, and they were telling me they were starting to raise capital to set up like short gold and short commodities, a hedge fund back then. And then basically since then, the gold price has just rallied enormously to $2,336. The silver price is almost at $28 at $27.76. In your opinion, why has gold demand picked up in the last few months in China or India? And why do you think the rally has just started in the last couple of months?
Yeah, no, that's a good question. As we know, sort of for last year and really since October of 2022, which is when gold kind of started to move up, the buying has been almost exclusively central banks. And if you look at the numbers, you can see that central bank buying really explains the rise in the gold price. And at the same time that was going on, we saw steady outflows from the gold ETFs. We saw coin buying in the US collapse. We saw coin buying in Europe go down. And so you look at the different components of gold buying, and it was predominantly, overwhelmingly central bank buying. Now, this year, we've seen continued buying by the central banks, although we only have January and half of February's numbers out yet. We don't even have all of February. But certainly in January and February, we had continued central bank buying. We've had Chinese retail buying come in this year, particularly since the Chinese New Year, but even before that. But, we've still got outflows from ETFs. So if you look at even just the last week, when gold moved up to 2,300 and over 2,300, you've had 3 days of 3 days of inflows and 3 days of outflows from gold ETFs. So I think the way I would look at it is that we're just beginning to see a turn in interest in gold, frankly. Up until the last few weeks, it has been almost exclusively central bank buying and Chinese speculative retail buying, as well as, I suspect, very wealthy Middle East and Asian families buying physical, but of course you don't see numbers on that. That's not reported. So in sum, I think the lack of interest in the West is actually a very positive from a contrarian point of view, because it means we've got a lot of potential buying still to come.
Yeah, that's funny you bring that up because, a lot of Western bullion dealers in the US and Canada, they're flush with inventory. I think premiums now for retail investors who want to go buy coins or bars, they're starting to fall like crazy now.
Yeah, no, absolutely. And that's a sign of lack of interest. Coin dealers I talked to in both the US and in Europe, now this is admittedly 2 weeks ago, but they all said that they have more people coming to them to sell coins than they do people coming to them to buy. And part of it is just the fact that the price is high. That always brings out sellers, of course. But I don't think that's the main reason. In the US, the main reason seems to be, frankly, that people are just kind of hurting. We might want to talk about this. I don't know. It's up to you. But, the headline reports on the economy, I think, are painting a much, much rosier picture than the reality. And I know I've got dealers who say to me, they've had people who've owned their coins for 20 years and say, hey, I'm sorry, but I just have to sell. I need the money. So we're just not seeing the interest yet. I think we're beginning to see it, but a long way to go.
Yeah, I agree. I think gold's climbing the wall of worry right now, maybe silver to a lesser extent too, but silver will eventually catch up in price and start to outperform on a percentage basis. But I think that will come later on. Right now, gold demand seems to be more than silver demand for now, at least. Although I think in Asia, I think the silver is selling at a $3 an ounce higher price. But that's interesting what you brought up with the wall of worry and the bullion dealers. I mean, I've heard similar stories. I mean, I've met people that have accumulated silver for the last 10 or 15 years. And one of them said that he doesn't believe the rally is real. And he's talking about selling 50 kilobars. So he's been accumulating these. I think he started at around $4 or $5. He was buying at 10, all the dips. And now he's just given up that silver is going to break 50 or whatever. And he wants to cash out.
Yeah, a couple of points on that, if I may. I mean, one thing, actually, silver's now outperforming gold for the year. Which is interesting. Just in the last week, and it's outperforming since the end of February. But that's certainly that's outperforming from a much lower level, of course. Yeah, I think the big danger for people who've been around the market, whether it's the physical market or particularly the gold and silver equity market, the big danger is that we see a 20%, 30% move and we sell far too early. And the sentiment, but I've seen this movie before. I've seen the rallies that don't last, and I'm going to take advantage of it. That's a very real sentiment. But I think that's the danger, that people who've been around for so long will be the first ones out and will miss out on the big rally.
Yeah, I think what the average person and a lot of institutional investors haven't figured this out. Maybe Stanley Druckenmiller has, because he was starting to asset rotate out of tech stocks and into like Newmont Mining and Barrick Gold. Although, in my opinion, those are not low-cost miners anymore. But I think we're going to start to see in the next couple quarters, these miners start to outperform top and bottom line beats. And the cash flows, I mean, there were mining stock analysts or bank analysts that were using cash flow projections for gold price at 16, 1700 because the commodity price projections were having it lower. I mean, they're going to have to redo these cash flow projections at much higher metals prices going forward, don't you think?
Yeah, no, absolutely. And, I mean, there's a lot of reasons. Let's face it, there's a lot of reasons to have been negative on gold stocks, on gold companies. If you look at what happened in 2011, 12 with the, absolutely egregious ill discipline and overpaying for marginal assets, and then a year or two later having to write them all off. I mean, those are real things, and people don't forget that. But I think the sector has changed, and yes, costs are going up. But you look at where the costs are today and compare those costs with 2011, and costs of mining are actually lower today. You look at the oil price, which is of course the number one cost input in running a mine, not building a mine, but running a mine. Oil's what, $80 today, and it was $140 back in 2011. The second highest cost input are all of the local costs. So if you've got a mine, if you're a US company with an Australian mine, all of those local costs, labor, food, housing for your people and everything else. And the prime determinant of those costs is the Australian dollar. If you're reporting in US or Canadian dollars, then the Australian dollar is the prime factor. So if you look at what we call commodity currencies, which is the second largest determinant of costs, they're all far lower. The Australian dollar, the Canadian dollar, South African rand, they're all much lower today than they were back in 2011. And so, I would argue that despite the inflation that we've had, and despite a lot of companies missing guidance on their costs, I would argue that the costs are reasonable given where the price is, and the margins are actually quite robust.
So you think then in the coming quarters, maybe it's not Q1 because we didn't hit 2,300 gold for all of Q1. The gold price was still around 2,100 and started to move towards the end of January and February, started to get bigger and bigger moves. But do you think we're going to see these gold miners report in the coming quarters, what, $600 to $800 an ounce free cash flow margins?
Well, I won't say certainly operating margins higher than that, and free cash. Yeah, for a lot of them, I think so. But even for the first 6 weeks of this year, gold was over 2,000. And if you've got all-in sustaining costs, which is a little bit, we could argue about how all-in it actually is, but it's a metric that the industry uses so that everybody's reporting the same thing. So if you look at all-in sustaining costs, a lot of companies are at 1,350, even 1,250. You've got gold at 2,000 for the first half of this quarter. Those are still strong margins, in my view. I mean, let me put it this way. Any company that is not making money this quarter has a real problem.
Well, there were problems, right, with a few of the mines for Equinox Gold, and Greenstone's not online, and then Pan American Silver has some really serious problems at their Mexican gold mines, right? Those are high cost, high capex mines. They need to get the cost down. So, but yeah, other than those two, I think you're correct. So Newmont Barrick, I would say Newmont's not really a low cost miner anymore. I think their costs are what?
No, I agree with you.
So do you think then that Newmont and Barrick, can they actually get their costs back down? Or do you think that this is just an industry-wide problem with like ore grade, cost of capital, things like that, and they're not going to be able to, say, get their costs back down to 1,200 anymore?
Yeah, certainly grades are an important factor. And you know this, and I'm sure your listeners know this, but we've seen a steady decline in average head grades, not just in the last couple of years, but over the last 10 and 15 and 20 years. So, yeah, that's certainly an issue. Capital costs are much more problematic than ongoing costs. So any company that's building a mine right now, has probably already factored in higher costs or is going to, or has, missed their guidance on costs, because capital costs are much more, have risen a lot more than operating costs. But I think, I think any company that has, whether it's Newmont Barrick or Pan American, any company that has a range of assets in different countries, they're always going to have some problem at some mine, pretty much every quarter. We know that mining is a very, very difficult business. There's that saying that Murphy's Law, anything that can go wrong will go wrong. And Robert Friedland likes to say in mining, Murphy works overtime. So, there's a lot of potential for things to go wrong. And frankly, that's just part of the business, and you can't get away from that. So if you look at a company like Pan American, they're always going to have a mine somewhere that has a problem or is underperforming. More important to me is, the company-wide metrics.
And you're saying that some of these larger miners, they can absorb a problem at a mine. So Newmont had the problem at Peñasquito, but they're not going to go bankrupt because they still have some lower cost mines in their portfolio that are operating, and they can over time fix the problems at Peñasquito. It's like the single asset, or where the miner has one or two assets in production, or they bet the whole company on the mine, like in Argonaut Gold. That's where the risk, the majority of the risk is right now.
I know. I think so. Absolutely. People like to say in this business that anything can go wrong. Anything that can go wrong with a big mine can also go wrong with a small mine. So the worst of all is when you have a small mine, however attractive it appears, but you have a company with a single asset, a small mine in one jurisdiction. That's where you have problems. If you can spread your mine risk, your jurisdictional risk. Look at Barrick, for example. They're in pretty much every risky country in the world, but at least they've spread their risk. So we're not going to have, we hope, we're not going to have a problem in every country at the same time. Yeah, no, absolutely. I agree with you. The single asset mines are obviously much more risky.
Well, Argonaut Gold was in Canada, but there was, I think, construction delays. So it was like the plague of all of every single case study, pretty much, of building a new mine, that the mines almost never, I think it's almost 90% of all new mines over the last many, many decades, they do not come in on time and on budget. And then when you're a single asset producer, you basically have to bet the whole company on the one mine there. And then
Sure.
with interest rates where they are, cost of capital where they are, I mean, then you're looking at the management team has to be like, okay, Franco-Nevada, you want to increase your royalty, give us some more cash.
Right, right. No, absolutely, absolutely. No, and that's particularly dangerous now because if you designed your feasibility 3 or 4 years ago when rates were much, much lower, and then you have a cost overrun, you're raising more money at much higher cost of capital right now. No, I agree 100%.
So, Adrian, you just laid out the case then where I think there's not going to be as many new mines brought online at the current metals prices unless they either stay at these levels for a couple of years minimum or go higher, because then the smaller miners are going to say, wait a second here, what it's going to happen to Argonaut Gold? They were bringing a mine online in Canada. It should be safer. And they still had problems and had to give away the mine for pennies on the dollar to Alamos Gold.
Yeah, I think, yeah, I'm not sure I completely agree with that. I think you're going to get caution for a while on the part of larger companies wanting to acquire exploration and pre-development projects. But optimism is rampant in this industry. And the truth is, if you weren't an optimistic person, you shouldn't be you shouldn't be in the gold mining business to start with. So, I mean, I think a company that has a good project, is exploring a project and developing it. I don't mean building it, just developing it. I think they're just going to go ahead on a normal time frame. Frankly, I don't think things are going to change because of the problems that Argonaut or someone else had.
I think we're going to see probably more splitting of deals, like with what Osisko Mining did with like Goldfields, and they have a joint venture partner. So Goldfields is 50-50, right? It's 50-50. And then Barrick Gold and Newmont in Nevada, right? With the Robertson and Cortez complex, they're splitting the bill. It's 50-50.
Yeah, and a lot of those things are just, they're two different cases, of course, but Nevada is a perfect example of something that should have happened 30 or 40 years ago, and it didn't happen because of egos. I think I can say this without being rude, but it's an irony that it took the ego of Mark Bristow to actually get the thing done. But I mean, that was a logical thing. That should have been one operator because they share a lot of the same projects. Osisko Development obviously is a little bit different, but I think you're going to see more of that. You're right. When you have large capital requirements, people are going to split it. Yeah.
Or they'll sell a large stream if it's like a copper mine with gold or silver byproduct. Because I know you've been doing this a long time, Adrian. Like, weren't royalty and streaming companies back in 2008? They were niche, and now they've grown enormously. Now it's kind of mainstream finance for a new mine. If it's a copper mine and you have some platinum group metal or gold or silver byproduct to sell a stream now to help reduce the cost on the mine.
No, absolutely. It's just a normal part of a financing package. And depending on where you are, depending on how hot the equity markets are, depending on whether, what the rate of interest is, US banks are not lending to mining projects right now, and European banks are, pretty difficult to get mining finance. Canadian banks are still doing it. So at different times in the cycle, equity is more attractive, debt is more attractive. Streams or royalties are more attractive. But you're right, royalties and streams are now just a normal part of a package. But almost anyone building a new mine looks at all of those opportunities, and they even look, some of them, at gold forward sales. You look at all of the options and just decide which is most attractive at any given time. And normally you have to use more than one.
Especially for base metal miners, because they're not given any credit for all that gold or silver byproduct. So they may as well just sell a stream on it now, get the cash to help build their mine, and then they can get the mine built faster, say copper, and they could generate free cash flow from their copper. I've heard like the CEO of Freeport-McMoRan talk about that even though they're, I think, the second largest annual producer of gold, they're not given credit for it in their valuation.
No, absolutely. Absolutely. Yeah, no, doing a byproduct stream is obviously it's a lot easier for the company. It's a lot easier to create that stream because the byproduct, whatever it is, whether it's gold or whether it's something else, the byproduct is not as essential to the company. That's not what they get their credit for.
So, in your opinion, what do you think would have to happen for a re-rating, revaluation of these gold royalty stocks and these gold miners, so that way the share price starts going up enormously? Because I would argue, I don't think these shares are pricing in anything close to $2,300 gold. It looks like they're pricing in what, 17 or 1800 gold right now.
If that. No, I mean, that's a good question. I think some people might argue with your premise that the royalty and streaming companies aren't properly valued. I mean, you know, a lot, they obviously on the surface have attractive valuations. But, you know, if you look at the miners, the valuations are just ludicrous in my mind. They're just absolutely ludicrous. You got gold at 2,300 or over 2,300. And as we said, the margins are still reasonably attractive. The outlook for gold is positive. And yet you look at a company like Agnico Eagle, the third largest gold mining company, which has no particular hairs on it, right? It's got a good balance sheet, good management. It's in safe jurisdictions. It's got 5 different mines, but in good jurisdictions.
They own the two best mines too, I would argue.
Yeah. And so that's why I pick Agnico. But Agnico, if you look at Agnico at the beginning of February, at the beginning of March, so it's changed a little bit since then, but at the beginning of March, it was trading at its lowest price to free cash flow ever. That just doesn't make sense. If you look at Barrick's price to book is its lowest in 40 years, other than the last quarter of 2015. So these stocks are still remarkably inexpensive. Now, we all know that, value is much more important than price. But if you just look at price, the XAU and all of these stocks are lower today than they were a year ago. They're lower today than they were 2 years ago. And they're lower today than they were 3 years ago. Forget 2011, forget the highs. Just look at the last year or two. And so, again, these stocks are incredibly undervalued in my mind, particularly given the price of gold.
I would say in the past, and I saw this with new mines coming online, that the market would start to price in when construction was done with the mine and the mine was ramping up to first gold pour and cash flow positive at the mine economic production. The market would start to price this in maybe 6 months before, and then by month 1 or 2 months out from cash flow positive at the mine, you'd start to see a pretty sizable move in the shares. You are not seeing that now. I mean, with new mines that are coming online, Greenstone and others, with construction done and it's first gold pour probably in the next month or so.
Yeah. Well, I think there's a little bit of, there's definite hesitancy or, people are still a little bit suspicious. You look at the Cote Iron Gold's project up there, that had enormous cost overruns, of course. And so I think there's a little bit of, wait and see to see if actually production, if they have hiccups during production. When a mine has 100% cost overrun, you sort of begin to be a little bit cautious on jumping in at the first gold pour. So I'm agreeing with you completely. I do think Greenstone, you mentioned Greenstone. I mean, I do think Greenstone appears to be a very solid mine, and it has the potential, to be not only the best mine in Equinox's portfolio, but, one of Canada's best mines. But I do think there's a bit of a wait and see attitude at this point.
So if I could sum up when you think gold stocks could be re-rated, you think the market's going to take a wait and see approach. It's kind of very skeptical of this move in gold. And then they want to see earnings over a couple quarters then for these gold miners to see what type of free cash flow they have. If they're beating top and bottom line, you think that that's kind of the approach the market is taking, especially like these generalist institutional investors who normally would not buy gold stocks. They won't go into any of these gold stocks until they see those types of things first.
Yeah, no, I think that's right. Now, of course, it's a continuum. It's not as though, one day stocks are going to be cheap and the next day they're going to be overvalued. But it comes on a continuum. Some people come in at different moments. But I think you need a few things. You need gold. If gold can stay over 2,300, that'll be a very significant indicator, because gold at 2,300 is starting to get attention in the mainstream media. It's astonishing to me how little gold has been, it's maybe astonishing, maybe it's not, how little gold has been talked about, even though it's hitting these new highs. But you see gold over 2,300 on a sustained basis, I think people have to talk about it. That's number one. I think number two, certainly this quarter, if the major miners can come out with some strong free cash flow this quarter, that will get some attention. And then the third thing I think is, I think you need the broad market to stumble. I don't mean to collapse or anything like that, but you just need to see some of these leaders stumble. And we're beginning to see that. Apple is down this year. Tesla was on Friday the largest decliner in the S&P 500 this year. So some of these erstwhile leaders are beginning to stumble a bit. And as you see the entire S&P sort of come off a little bit, people will start to say, okay, let's take some profits in NVIDIA and in Microsoft, and where should I be putting my money? And they'll be looking at different sectors. They'll be looking at foreign markets. They'll be looking at emerging markets. They'll be looking at small cap. They'll be looking at, Russell 5000 type stocks. They'll be looking at value stocks, all of those areas that have lagged. And they'll be looking at commodity stocks, including oil. The oil stocks really haven't moved until very, very recently. They've been lagged. So some of that money will go into gold and silver stocks. So I think there's several things that, it would be nice to happen. And if they all happen, I think then you could get some pretty strong moves in gold. But you mentioned you mentioned a very interesting phrase there, the generalist investor. I think the generalist investor who doesn't really know gold, doesn't really follow gold, he's been burned. He's been seriously burned. If you think back to 2000, and, first of all, he was buying in 2006, 7, and then we had the financial crisis in 2008. And, the generalist investor says, well, wait a minute, I thought gold stocks were supposed to protect me in a decline. And then 6 months later, gold's back up to the races, and he buys some more. And in 2011, the XAU lost 86% of its value. The XAU, not the Ajax expiration or anything, 86% of its value between 2011 and 2015. The generalist looks at that and says, whoa, what am I buying gold stocks for? I just don't understand it, and there's something wrong. So it takes a generalist, I think, a lot of time, and as you say, several quarters of good results to step back into this market.
Well, also, if you have those beats, like I said, then you'll start to see the gold miners and the royalty companies move up to the top on the investors' business daily list for which stocks are beating the expectations of the analysts and stuff. And then that's when like the momentum guys, the hedge fund guys, the generalists will start to look at, hey, these companies are beating on top and bottom line. They're finally starting to move. And then that's when they come in.
Sure. And then at the quarterly fund board meeting, someone on the board will ask the manager, why don't you have any gold stocks in your portfolio? And, the guy will go out and buy, 1% position in Barrick or something. So, yes, but all of that takes time, I think. But
yeah, I agree. Probably Q3, probably a couple quarters we need of higher metals prices and good numbers from the miners and the royalty companies.
Yeah.
But the mainstream financial media, I mean, some of the articles on gold are laughable. They're interviewing fund managers. They're saying like it's head scratching why gold prices are going up, given that the dollar is strong and interest rates. So they're talking about that. They're talking about, well, there's a lot of deflation signs in the economy. And then also like they're painting anyone who's buying gold now. I think Larry Fink, who did a 180 on Bitcoin. He's saying that anyone who buys gold is anti-financial system or something like that, that is damaging to the capital markets and the financial system. And then also that anyone who buys gold or silver right now is just a doomer. There's like, this narrative that's being painted in the mainstream financial media of anyone who says anything nice about gold or silver.
Sure, sure. And of course, if you buy gold, you're supporting Russia and all sorts of stuff.
Even though gold is money, right? So gold is it's stored purchasing power, everything. The old JP Morgan quote that gold is money and everything else is credit.
Yeah, no, absolutely, absolutely. Well, I think the reason is that most people, including Larry Fink, do not understand gold. And so that's why they're scratching their heads saying, why is gold going up?
Or he's just decided that he's anti-gold and pro-Bitcoin now.
Yeah, that's the irony.
That's what it seems like to me. He's done a full 180 on Bitcoin. He's a Bitcoin salesman now. He's buying Bitcoin miners, full Bitcoin with his Bitcoin ETFs. Got those approved easily when it took a lot of other people took years and couldn't get it done.
Yes, quite. Well, no comment.
Well, it's easy when you know a lot of people in DC. The old Ayn Rand, the system of pull there with Atlas Shrugged.
Yes, yes.
I want to ask you about funding for juniors. So are we at the stage now where you think that juniors are going to start to raise private placements for, I don't know, 10, 15, $20 million and start drill programs, or are we not there yet?
Well, we're certainly at the stage where, we've been getting a lot of companies raising money just in the last week. And some of it is exploration companies who might only be raising 2 or 3 million. Some of them are larger. I-80, for example, today did a 85 million bought deal. So yeah, people are beginning to take advantage of that. Mostly people who need the money. But I think if we stay up here for any length of time, you'll start to get a lot of companies raising money. And the problem with that is right now you're really fishing in the same pond. So if Ajax Exploration, which doesn't exist, of course, if Ajax Exploration raises $5 million, that's probably $5 million that investors sell from other gold stocks. You're not really expanding the universe very much at this point, I feel. But you're just cannibalizing, the sector.
Yeah,
and so, yeah.
It just seems that there's not as much capital available in the last decade because the Canadian merchant banks that used to do a lot of these help do the private placements, they've backed away from that. The mining stock ETFs, if a mining company is not in there, they don't get as much capital or a higher market cap. But then the mining stock ETFs are passive. So the company's not getting direct funding anyway with equity financing and stuff. It's just their market cap's higher in a mining stock ETF.
Sure. No, absolutely. That's true. But yeah, we're seeing a lot of companies raising money right now.
That's good. Hopefully, we'll start to see some new discoveries. I know you wrote about one in Nevada recently with Anglo Gold Ashanti, but there's no pre-feasibility on it. But there are some royalty companies that do have claims on, a royalty on the land.
Yeah, no, absolutely. That's an astonishing discovery, and it's grown so quickly. A year ago, Anglo put out their first resource estimate on this area called Silicon. And I think it was a 4 to 6 million ounce exploration target, they call it. So, which is similar to a indicated and inferred. Similar. And then in August, they put out a similar, actually, 4 to 6 million exploration target on the adjacent deposit that was called Merlin. So that was in August. So for a combined, actually, I got the first one wrong. It was 4.2 on Silicon, sorry, and then 4 to 6 on Merlin. So we were looking at 8 to 10 on the whole thing. We're now at over 13 million just in 6 months. That's pretty astonishing. So they've been
That's
very
just
good.
gold, or is that like mixed with other metals?
No, it's all gold. So that's pretty aggressive. They've been very, very aggressive drilling, but they've really had great deal of success in building that deposit. So that's basically from a running start 2 years ago. I mean, 2 years ago, this was nothing. So over 13 million ounces right now. Yes, there's two companies that have royalties on the area. One is Altius, which of course is a diversified commodity royalty company, and then the other one is Origin, which is a much smaller company, which has a royalty on the Merlin Silicon deposit. So I think those royalties are going to be, extremely attractive, and clearly the major royalty companies are looking at those. There's no question.
Altius already has free cash flow. So Altius is dividend growth, free cash flow. So the majority of their royalties, though, are not gold and silver. But this Origin one, is that like a new company? It's a spinoff or something?
No, Origin is, it used to be called Evrim, and it was a prospect generator. And then a couple of years ago, they bought Renaissance, which was another prospect generator focused on Nevada. So they merged with them and changed the name to Origin. And it was Renaissance actually that had the royalty on Silicon, which Origin now has. So Origin is now, I guess you would call it, a royalty generator company. They have a producing royalty on the Ermitaño, which is First Majestic's Santa Elena mine. So next door to the Santa Elena deposit is this thing called Ermitaño, which is where most of the feed for the Santa Elena mill is now coming from Ermitaño. And that's generating cash flow for Origin. So no, I like Origin a lot. I mean, it has cash flow, it has free cash flow, it has $18.5 million cash, which is pretty strong for a junior, exploration company. And of course, they have a royalty on this silicon.
Yeah, it sounds like a lot of optionality. And the business model sounds similar to EMX royalty, because EMX does prospect generator. And then if they find a mine, they sell it to a larger mining company and keep a royalty on it.
Yeah, the basic model, royalty generation, is the same. I mean, I would point out that Origin actually has free cash flow, which is very powerful in the junior space.
Yeah, these small royalty companies, for our listeners out there, I mean, they're normally acquisition targets. So if there's a large discovery for a royalty company like Great Bear Royalty, they only owned one asset. And then once the discovery was announced, I figured out pretty quickly that one of the larger royalty companies like a Franco-Nevada or Wheaton Precious Metals or Royal Gold would target it. And that's exactly what happened.
Yeah. Well, and that one, as we were talking offline before, that was sold before they even had a feasibility or a resource estimate.
Well, Kinross, I think, felt that they had to go in there and buy it then, because if there was a feasibility, even a pre-feasibility or feasibility study, there's no way they would have won a bidding war against a Newmont Mining or a Barrick Gold. And it was very similar for Royal Gold, because if there was a feasibility study on it, they're not winning a bidding war with Wheaton Precious Metals or Franco.
Well, maybe not. I mean, they won the bidding war with Cortez simply by overpaying.
Yeah.
Now, Royal Gold would argue that they didn't overpay, but yeah. Well, I mean, this is a problem when you have a royalty that goes to an auction. There's always someone, for whatever reason, but is going to pay wants to pay more than everyone else and arguably overpay. It might be because they simply have a lot of cash on the balance sheet and haven't done a deal for a while, so they want to buy something. It might be because there's synergy with something they already own, like Royal Gold already has a royalty on Cortez, so they wanted the royalty on the new part of Cortez. So there's always a reason that someone will be willing to pay more than other companies. And that's a problem from the buyer's point of view. That's a problem with when these royalties go to auction. Of course, from the seller's point of view, it's great because it means you get top dollar.
Yeah, exactly. And value is subjective too, as well. But those royalties, I mean, one of the major components is exploration upside. So you might be overpaying, like you said, for the existing resource, right? But if there's exploration upside, then that's not in the current valuation and the cash flow estimates.
No, absolutely. And you look at, say, Franco, Paul Brink, and Randy Smallwood from Wheaton. I mean, they both basically say they're prepared to pay a fair price for what is known. But what they're really buying is the optionality in the mine. And of course, the gold price going up is, I don't think the companies at the moment, not Franco and Wheaton, are paying up because they think the price of gold is going up. They're paying up because they see exploration upside. And that's why these companies, when they buy the royalties or streams, they will make sure the stream is attached to as much surrounding ground as ground around the mine as they can get.
Has Franco been aggressive with new deals lately? I know they added on the Mangino side and they bought like a package of oil and natural gas royalties in Haynesville area. I think of what in Louisiana near liquefied natural gas export facilities. So it's pretty close to there. But I wouldn't say they've been super aggressive. It's not like they did a hostile takeover on a Cisco Gold royalty. The shares are still sitting around $120 right now.
No, they haven't done a lot of big deals lately. As you say, the biggest one they've done in the last 6 months, I think I'm correct in saying, is the oil and gas. I mean, just on Friday, they didn't announce, but Scotty announced that Franco had paid 8.1 million for Canadian for a royalty and shares. So that's a pretty small investment for Franco. So they've done a few small investments like that. So is Wheaton. Wheaton's done some pretty small ones as well.
Well, Wheaton didn't in November. Wheaton did around 500 million deals on Platreef, right? So with a platinum group.
Yes. No, Wheaton's done some big ones as well, but they've also done a string of 20 million and 10 million. And frankly, the reason they do this is so that they're in a position like Wheaton, for example, did a 20 million deal with Vista, which has the Mount Todd in Australia. 20 million, and that was a royalty, which is very unusual for Wheaton. 20 million royalty for Wheaton is nothing, but it positions them for, if that mine does go into production and there's a need for a major stream, it positions them to get the stream, or at least have a heads up. And they've got a ROFR, they've got a right of first refusal on.
Yeah, that's important for future mines because if we do, copper price does go to $5 or $6 a pound, there will be a lot of byproduct deals. So the companies want to try to lock up rights now so they don't get into the bidding wars that you described earlier. So if they have that royalty on a junior and all of a sudden there's a discovery, they don't have to get in a bidding war with a competitor to go buy a gold or silver stream.
Sure. And typically it's a right of first refusal. So someone else can always come in and overpay. But having that right of first refusal and already having a royalty which gives you access to information, it just puts you in a much stronger position to actually win the big prize.
Now, at $120 a share, do you think that all the bad news is priced into Franco-Nevada and none of their future growth in the next couple of years is priced in yet?
Well, those are your words, not mine. But I would. No, I would say that at 120, it's certainly discounted. It's certainly discounted fully. It's discounted Cobre Panama, which, as you know, was their largest investment ever. And they've written it off completely, as you know. So anything positive coming out of that is upside from here, but I don't think is in the share price at all. And the upside might be, it might be the new government in Panama coming in May, which is likely to be business friendly. They might negotiate with First Quantum, and I'm not sure this will be the outcome, but they might negotiate with First Quantum, and First Quantum gets to operate the mine again. Maybe there's a higher tax, maybe there's this, maybe there's that, but that doesn't affect Franco's stream. So that's one way that Franco could get rewarded. The other way, frankly, is if is arbitration. You know, they've already initiated arbitration. People I know, you know, lawyers tell me, you know, that should be a winnable arbitration. Now, you still have to collect, of course, and it will take time, but both First Quantum and Franco should win in an arbitration. But of course, the problem with a stream negotiated with a company, is that if Panama takes a mine from First Quantum and sells it to someone else, then Franco doesn't have a stream on that asset. The more difficult thing would be is if someone buys First Quantum, you know, a Barrick or someone just buys First Quantum. The stream would not transfer unless that was part of the purchase and sale agreement. So it starts to get a little bit messy there, because if First Quantum, for example, were to sell the mine to someone and the stream was not included, then Franco would have a claim against First Quantum. But again, that starts to get messy. And
that sounds really unusual, because normally when, let's say, whether it's a case with like the Caserones mine that Lundin Mining bought, I mean, like these royalties and streams normally transfer over. You're saying that this contract was structured that was not the case, because normally
right. And it also doesn't apply to any of the other ounces that First Quantum produces, you know, and that's another thing that you've seen in the last 15 years or more, ever since Pascualama. Companies will typically do a stream, and if that particular mine doesn't come into production by a certain time and start producing, then the streamer can get ounces from the rest of, in this case, Barrick, from the rest of Barrick's worldwide mines. And that does not apply in the case of Cobre Panama either.
That's interesting. I didn't know the deal was worded that way, because like that might be the exception. I've never seen it before where the stream didn't transfer over. It must have been like an old agreement or something like that.
Well, it was an unusual case. Let's just put it that way. And that's why Franco spent so much time, you know, debating whether or not they wanted to do the transaction, because they didn't have the normal protections.
I see. And supposedly, like Randy Smallwood has said that Wheaton was actually offered that deal first, and he said that's one of the reasons they walked away.
Yes.
Well, about Franco's growth, I've heard people say that basically without Cobre Panama, they have no growth. Do you agree with that statement?
No, that's not true. They've got three good mines coming on this year. Let me see. They've got the I can never say it, Tocantinzinho in Brazil, that's coming on. They've got oh my gosh, they've got three coming on this year. I can't really remember which three they are.
Mangino too. They just increased the royalty on Mangino from 2% to 3%, and Alamos Gold owns it now, so that's a better counterparty too.
It's a better counterparty. I'm not sure when that's expected to come into production. But anyway, yeah, they've got three mines, three new streams. Well, one royalty and two streams that are going to come on this year. I'm trying to look and see if I can find it quickly while we're talking. But
it's in their investors presentation, the slide deck it listed. If our listeners want to go look it up, it's there on the Franco-Nevada website.
Sure. So I absolutely don't think it's true to say they have no growth. No,
yeah.
Not at all.
Well, I just repeated what the bears are saying. I don't agree with that. Yeah. I mean, I think there's at least 20 or 30% upside. The gold price stays at these levels and their growth comes online, because at 120 shares, I mean, the sentiment's just really negative in the stock, and it's not pricing in the cash flows at the current metals prices.
Yeah, well, and the sentiment is particularly negative among generalists, because the generalist bought Franco-Nevada thinking, oh, well, this is a safe way to play gold. I won't have the same sort of problems I had with Barrick and Newmont and Goldcorp and everyone else. And then this happens. So the generalist just feels like, he just can't win in the gold space.
This is why you don't buy all of your position at once, but it's good for those of us who didn't buy Franco-Nevada at 150 or 160. There's a bargain here, I think.
Oh, yeah, no, absolutely. No, no, we've been buying it. I can say that.
In terms of like valuation with like free cash flow discounted, any other gold stocks like mid-tier miners, do you think that there's better value for mid-tier miners now than Newmont Mining or Barrick?
Yeah. I mean, I think B2 Gold is a very good company, and their share price is depressed because they're building a new mine up in the Yukon. So it's difficult to build mines, in the Arctic Circle, particularly with a company that hasn't got experience in the Arctic Circle. And so doesn't have experience. And so, that's why B2 stock price, or one of the two reasons why B2 stock price has been hit in the last 6 months. The other one, of course, is the problems in Mali, no question. But, I certainly feel confident that they will be able to build that mine and bring it on stream. That B2 has a very good reputation of building mines and bringing them on. Good balance sheet.
Isn't dividend yield like 6% or something?
And a good dividend, yeah. So I like that one. And I do think, I mean, I still like companies like Agnico because, the truth is, and we do own a lot of Barrick, the truth is when the generalist starts to come into gold and retail starts to come into gold, they're going to go to, the retail guy is going to call his broker and say, I want to buy some gold. What shall I buy? Well, the broker's going to say either buy the GDX or buy Barrick or buy Newmont or buy Agnico, but he's not going to say buy, Orion or Mondoro or Midland. And so those are the stocks that are going to start moving first. And you see that in every cycle. The big cap stocks always move first. So I mean, I still like Agnico. I would buy Agnico. I still like Barrick, although I'd probably wait for Barrick. Cisco royalties I like, but among the juniors, B2 I think, or mid-tier B2 I think is a very good company. And there's several in the junior space that we like a lot that are very, very, very undervalued, I think.
Yeah, the juniors are really undervalued there because if they have to take on a lot of debt to build the mine, or the market's worried that they have capital raise issues, do you think that we're going to see some of the mid-tier miners start to buy some of these juniors because of the mispricings soon, saying that like, well, I can buy gold in the ground. There's no point in building a mine. I'm just going to buy something that's already producing then at a cheaper discount.
I think you'll see that, but I think you'll probably see them buy a company for one particular project. So rather than buy a company for a group of projects, so they might buy whatever it is because of one project that the company has. Yeah. No, you're definitely going to see that. And that's what we saw with B2, of course, when they bought Sabina. So we're going to see more of that, I think. Yeah.
Did they spin out the other assets? So like, I think what we've seen with Argonaut Gold is that Alamos Gold got the mine it wanted, and then the rest of the stuff was spun out. You think we're going to see more of that then?
I think we're definitely going to see more of that. You didn't really see that with Sabina because they didn't have anything else. But I think you're going to see more of that. Yeah, you'll buy the company for one project and then the rest will be spun off. Yeah.
Interesting. Well, I want to thank you so much for your time today, Adrian. I think we could talk about gold stocks a lot more. I know you were just in Switzerland for sentiment for gold. Is there a lot of interest now in gold and gold stocks in Europe and Switzerland?
There was definitely a lot of interest in Europe at this conference. Now, of course, a lot of these people have been around the gold market a while, so I didn't come across any or many brand new people, to be honest. People who said, gold's at 2,200, let me look at gold. I didn't see any of those. But certainly a lot more interest in the gold space. Yeah, no question.
It sounds better than the Denver Gold Forum last summer. I think it was empty.
Well, there were a few people that took photographs at 4:00 in the morning, which I think was a little unfair.
Oh, they were literally at 4:00. I didn't hear that one.
Well, maybe 6 o'clock, but yeah. But
Got a lot of clickbait on Twitter. It sounds like someone did it intentional to get extra clicks or views on Twitter.
yeah, yeah. But no, it was not the most attended show. We can say that, yeah.
Well,
But it
I'd
was,
say
but it wasn't that bad.
well, gold was like in a trading range for the last like year and a half, 2 years prior to the last 3 or 4 months. I mean, it was stuck in a trading range. Every time it get to around 2000, it would get, or a little above that, like 2050, get whacked back down.
Right, right. But I think, as you said, it's changed now, and when we start seeing the Federal Reserve ease, and that will be followed shortly after by Britain, by the UK and Europe, then I think that's going to get attention.
I want to thank you so much for your time today, Adrian. If my listeners want to check out your newsletter or your asset management, how do they do so?
Yeah, the best way is just to look at the website, adrianday.com.